Thank you. We're here to talk about how tariffs and rising global uncertainty are going to, likely to affect the New Zealand economy. And we've got to focus on medium-term inflation pressures because that's what matters for monetary policy. I thought I'd start with just a quick recap on where we are at in terms of monetary policy and inflation. So the Monetary Policy Committee, currently 6 of us, 3 internals, 3 externals, normally 7, waiting for a new governor. But the MPC expects inflation to stay near the top of our 1 to 3% target range over the middle of this year. And a lot of what I'm going to talk about in terms of forecasts are based on our May monetary policy statement, which was kind of updated a little bit in our July monetary policy review. So I'm not going to comment a great deal on any recent data outturns, but I will note that the CPI number that came out on Monday this week at 2.7% is very much consistent with MPC expectations of having inflation near the upper range of our 1 to 3% target over the middle of this year. But we've also got spare capacity in the economy, and we've got easing core inflation. So the MPC, we expect inflation to settle around that 2% mark by early 2026. In terms of interest rates, we've already cut the official cash rate from 5.5% last August to 3.25% now. We did hold it steady a couple of weeks ago, but we see scope to lower it further if medium-term inflation pressures keep evolving as we anticipate. Now, of course, as I've said publicly many times before, the outlook for the OCR is contingent. It depends on what happens with the economy. So, the outlook depends on what happens next. And right now, there's a lot of uncertainty out there in terms of what happens next. We are a small economy, a small open economy. It's a big volatile world. We export what we're good at. We import what others do better. We don't save a great deal, so we rely on offshore capital to fund growth. And we're well integrated into global financial markets. So what happens overseas really matters for us here at home. On tariffs, they are back and uncertainty is rising. So this is reshaping the global economy in ways that will affect our growth, our inflation and monetary policy. So today, the sort of kaupapa for the speech is I want to lay out where we're at with all of this and especially how it will shape inflation and the OCR over the medium term. Of course, worth saying up front, it's a fast-moving picture. It is evolving. So what I'm going to talk about today is our current thinking, and we'll keep refining it as new data, new research, new modelling comes to hand, both from within the RB and from outside of it. Okay, so some key messages that I'd like to get across. Firstly, and I've sort of hinted at this, New Zealand, we're deeply influenced by global development. So even if tariffs don't hit us that hard directly, we will feel the ripple effects as they work through the global economy. Second, tariffs are likely to slow the global economy, and that will put downward pressure on our exports. Third, uncertainty, both here and globally, is holding back business investment and household spending. A lot of firms and people are sitting tight at the moment, waiting to see what happens next. Now, fourth, for us around the MPC table, this looks like a negative demand shock, and we think it will reduce inflation pressures here in New Zealand. And that's quite different to the United States, the sort of epicenter of tariffs currently, and tariffs there, many people think are expected to increase inflationary pressures in that economy. And final key point, we're watching closely, we're constantly updating our analysis, and we're ready to adjust the official cash rate as needed, and that's how we will keep inflation low and stable through a turbulent time. All right, so let's start with tariffs. On the 2nd of April, the US announced sweeping new tariffs, and this included a 10% tariff on New Zealand. This graph goes back to 1900. It's average tariffs in the US. You can see we've sort of, during the sort of golden age of globalization, tariffs were quite low in the world's largest economy, but no longer. A lot has happened since that announcement on the 2nd of April. Tariffs between the US and China, they spiraled as the two largest economies went tit for tat. They peaked at about at 145% on Chinese exports to the US and 125% the other way. They've since eased a bit, and they're now sitting around 30 and 10% respectively. Still high, still disruptive. Now, there are also steep tariffs on steel, aluminium and cars, as high as 50%. Like about a week after that 2nd of April announcement, most countries got their tariffs reset at 10%, the same level as New Zealand, but that reprieve didn't last long. A couple of weeks ago, the US rolled out another tariff wave, which is due to come into effect on the 1st of August. And these numbers are moving around a lot at the moment, as you'll appreciate. It's kind of hard to get a fix on them. We sort of, every day we have to sort of rewrite little bits of the speech. But they're currently around 20 to 40% on Southeast Asia, 30% on the EU, although that's the headline today in terms of that being negotiated down with a trade agreement. And in terms of us in New Zealand, we're still sitting on 10%. Now, of course, that probably isn't the end of it. Tariffs are dominating the headlines, and there is no doubt more to come. But the direction, too soon. The direction of travel is clear. The US is decisively shifting towards trade protectionism. Now, that is a big change in the global trading environment, and it comes with real economic consequences. Okay, so that's a little introduction to tariffs. Let's talk about uncertainty, which is kind of the sort of cousin of tariffs, I guess. Tariffs, they're actually only part of the story. You can see from this graph, which is a measure of uncertainty going back to the early 90s, tariffs have pushed global uncertainty, according to this measure at least, to its highest level in decades. But they're not the only driver. So since the early 2000s, the world economy has been dealing with more frequent and more varied shocks, from financial crises to pandemics and wars to tech disruptions and bubbles bursting. The shocks just seem to keep on coming, ratcheting up uncertainty on the way through. Globalization is changing with fragmentation on the rise and economic tools increasingly being used for political and strategic ends, not just economic ones. There's actually a word for this. It's called geoeconomics, and it's where the logic of conflict meets the language of commerce. Not my definition, but to give you a sense of what geoeconomics is. In terms of what it does, it makes the rules of the game less clear. It makes the global economy more difficult to navigate, with spillover effects into the domestic economy. Does anyone miss the 1990s? I certainly do. As you can see from this graph, it was a pretty chill time. And I would argue that the music back then was fundamentally better than what it is these days. I just do not understand drum and bass. All right, so what does this mean for New Zealand? How will we be affected by changes in international trade? How will tariffs and uncertainty affect the New Zealand economy? And just to put the punchline up front, we currently see US tariffs leading to what we call a negative global demand shock, and that will reduce demand for our exports, and it will put downward pressure on global prices for our exports and imports. So how do we get to that conclusion? So tariffs, sort of at the most basic level, they are a tax on imports. So they make foreign goods more expensive for domestic buyers in the US in this case. So with imports costing more, US demand for goods imported from the rest of the world, including from New Zealand, will weaken. So this is the direct effect of tariffs. But there's two things that will soften that blow for us. I feel a little bittersweet about the first of them, and that is that we're not actually as export driven as we like to think we are. As you can see from this graph, this is exports as a share of GDP across a bunch of OECD economies, and you can see that our export share of GDP is low, especially compared to other small economies. So those are the bars in blue, countries with fewer than 20 million people. Most of them are at the right of the graph. New Zealand is one of the few down this end of the graph. Not only do we not export very much, but the export intensity or the export share of our economy is actually or has been falling for decades. So total exports were 31% of GDP in 1992, and they were 24% of GDP in 2024. Now, the second thing that will soften the blow of US tariffs is that a big part of what we export is tourism, and it's really hard to tariff a holiday, so that helps. Now, having said all that, the US clearly matters to us. We export around $16 billion worth of products to the US a year. That's about $7 billion in services and $9 billion in goods. And that's about 2% of our GDP. As you can see from this chart, that makes the US our second largest trading partner, just ahead of Australia, though still well behind China. Now, of course, the direct impact of US tariffs, it's going to vary by product. So US demand for New Zealand exports, it's concentrated in areas like wine, medical devices, manufactured equipment and meat. Of course, the direct effect of tariffs here also depends on how buyers and producers respond to higher prices caused by the tariffs. And this is what economists we call elasticity of supply and demand. So the negative effect on New Zealand through this direct channel, it'll be worse if US buyers scale back their demand a lot in response to higher prices for our products, or if US producers ramp up local supply a lot in response to higher prices for New Zealand exports because of the tariffs. In that case, we'll feel a sharper impact. So, yes, the direct effects of tariffs are real on the New Zealand economy, but they're also manageable, at least from a macroeconomic perspective. All right, so that's the direct effect of tariffs. Let's turn to the indirect effect of US tariffs. And the point here, we are part of a global market, and the US is a major importer of many of the goods we buy and sell internationally. So not from us directly, but as part of that global market or global markets for our products. So as the US or as goods into the US imports fall because of the tariffs, then global prices for those goods may weaken, and that will reduce the price that we receive for our exports and pay for our imports. And this is in general, not just to the US, so this is the indirect effect of US tariffs. So how big is this effect likely to be? Well, or at least prior to tariffs, the US accounted for about 14% of total global goods imports. So that's on average across all goods, all products. But if we want to assess the indirect effect of US tariffs on New Zealand imports, or prices I should say, for New Zealand imports and prices for New Zealand exports, we need to look at US demand in global markets for the specific goods that we buy and sell internationally. We did that across, well, I should say Lewis did that, across more than 1,000 product categories. And our assessment, having trawled through all of that data, is that falling US demand in global markets as the US retreats behind its tariff wall to some extent, that will, falling US demand because of tariffs is going to put more downward pressure on import prices in New Zealand compared to our export prices. And you get a sense of that from these graphs. So before tariffs, if you look at US demand for the types of goods that we export, it was about 10% of total global imports for those products. And that's less than that average I mentioned earlier across all products, which was 14%. And in particular, and you can see this up the top of the left-hand chart there, The US buys very little of the dairy products that we sell internationally. The US is quite closed in dairy products. So tariffs, as the US retreats a bit from global markets, tariffs aren't likely to affect global prices very much for dairy. And that's good for us because, as you can see from the numbers in the brackets, dairy makes up more than a quarter, 29%, I think, of our goods exports. Now compare that to precision instruments, which is a little bit down the graph. This is medical devices and the like, and the US accounts for over 25% of global demand for those products, much larger. So if US demand does fall because of tariffs on those types of products, then prices for those goods could drop too, which is obviously not good for the businesses involved in exporting those products to the US and globally. But from a macroeconomic perspective, it's likely to have a limited impact because those exports are only about 2% of our total export basket. Now on the import side, the US matters more. So around 16% of global demand for the types of goods that we import comes from the United States. So again, as US demand weakens, global prices for those products are likely to fall, and we could benefit from cheaper imports. For example, this is the right-hand side chart there, transport equipment, things like vehicles and machinery. It makes up 14% of our total import basket. And the US accounts for almost 20% of global demand for those goods. So if prices fall from the US retreating somewhat, then that could mean cheaper import prices for us. So just to sum up what I've been talking about with this slide, our export revenue may well soften in some areas because of the tariffs, but our import bill could fall too, helping to take some pressure off inflation here at home. All right, so that's the direct effect of tariffs and the indirect effect of tariffs. But of course, tariffs, they don't just reduce global demand, they also reshape global trade flows. So as well as buying more locally made goods, tariffs will also incentivize US importers to source goods from countries that are facing into lower tariffs. And if you're an exporter currently exporting to the US and you're hit by a tariff, you're going to try and sell your products to countries other than the US. So this process where trade gets rerouted to avoid tariffs or minimize tariffs, economists, we call this trade diversion. And we're already seeing a bit of trade diversion in action. You can see on this graph that Chinese exports to the US dropped by around 15% in the year to June. But overall, Chinese exports held steady because they redirected shipments to the EU and Southeast Asia and other countries as well. Of course, some of this could just be rerouting of Chinese products through to the US through third countries, but some of it will reflect genuine trade diversion as well. Okay, so what does that mean for us? Trade diversion could matter for us. For example, prior to tariffs, Chinese exports, so this chart here is trade flows between the US and China, which was the biggest sort of trade flows in the world, or at least prior to tariffs. And I just want to focus in on miscellaneous manufactured goods, and these are the types of miscellaneous manufactured goods that we import as well. And before tariffs, Chinese exports of miscellaneous manufactured goods to the US made up over 12% of global trade in those products. So as the US pulls back from global markets, more of those goods could end up here, Chinese exporters looking for buyers outside of the US. So this could mean cheaper prices for New Zealand customers. Now on the export side, we could benefit as well. If US tariffs make Chinese tech more expensive in the US or Brazilian meat more expensive in the US, then American buyers could start coming our way, and this could lift demand for some of our high value export and ideally sustainably produced meat. Now the extent of trade diversion It depends on how tariffs fall across different countries, the distribution of tariffs across different countries, and of course how those countries respond. Think of trade, it's like water, and it naturally flows through the path of least resistance, and tariffs are little dams that redirect those flows. And the key point I want to make here is that tariffs in New Zealand, our rate isn't higher than anybody else's at 10% currently, so that puts us on the right side of these global shifts in trade flows. We don't expect trade diversion to move the macro dial dramatically, but on balance we think it'll modestly ease inflation pressures here in New Zealand. All right, we're getting there. So that's the direct effect. It's the indirect effect and trade diversion. Let's switch to the supply side. Let's switch to global supply chains. And one of the main reasons that economists dislike tariffs, as in really dislike tariffs, is that they distort the incentives that make global trade efficient in the first place. So in a world without tariffs, we buy things from where they're produced most efficiently. And that usually means where they're produced most cheaply, and it results in a better resource distribution of resources globally. But tariffs, they drive a wedge between efficiency and price, and they can distort global supply chains, and they can make them fundamentally less efficient, more fragmented, less robust, and more costly. And this reduces the gains from trade. And again, economists, we've got a word or a sentence or a phrase for that. We call it dead weight loss. And we really don't like it, as you can tell from the name, dead weight loss. Who wants that? In New Zealand, we're no stranger to dead weight loss, I should say. For instance, we kept assembling TVs here well into the 80s, which you can remember if you've got a few years under the belt these days. And we didn't do that because it was efficient or because it made good economic sense. We did it because of tariffs. Tariffs made importing TVs too expensive. And that's the kind of inefficiencies that tariff barriers can create. Now, of course, in the current instance, less efficient global supply chains, because of tariffs, it's mainly a US story. So US tariffs are distorting global supply chains that pass through or end in the US. So this is about American buyers switching to local suppliers or suppliers that are based in countries facing low tariffs, even if those producers are less productive. It's about exporters into the US moving production to lower tariff countries, even if those countries are less productive. And there's been reports in the media, at least, of Apple shifting production from China to India. And that's a good example of global supply chains remaking themselves to get around tariffs. Again, in economist speak, we talk of these effectively, it's a negative supply shock. And in the US, they are likely to push inflation up. Even though the US is relatively closed, it doesn't trade a great deal. It kind of doesn't have to because its internal domestic markets are so thick and well developed and productive. But even so, this is a graph of imported intermediate products into the US. And you can see, even though the US is relatively closed, imported goods still make up over 12% of manufacturing output and capital investment in the US. And as those supply chains become less efficient, it will put upward pressure on prices in those areas. All right, what about us? What about New Zealand? Yes, there will be some spillovers. We will pay more if a good we import is now being produced through a less efficient global supply chain. But the impact is likely to be limited because New Zealand, we don't rely much on US-made intermediate inputs. That's what this graph is about. I think in the manufacturing sector here, for example, 3% of intermediate inputs are imported from the US. Not a huge number. And you can see the sort of light blue line. Goods that we do tend to import from the US, they tend to be made mostly within the US. So they haven't come indirectly from other countries, and therefore they're not necessarily exposed to the US tariff. So to some extent, this insulates us from these global supply chain distortions. But still, it's something that we're very much keeping an eye on. All right, we're kind of getting there. uncertainty. That's enough about tariffs. Let's talk about uncertainty and what it's doing to the New Zealand economy. We're actually publishing an analytical note alongside this speech that empirically looks at the effects of uncertainty in New Zealand. So our modelling shows that increasing economic uncertainty slows the economy down. And you can see the right-hand side there is the effect of one standard deviation increase on uncertainty on investment. The middle bit there is on consumption, and the left-hand bit is on the economic output all together. So economic uncertainty slows the economy down because businesses invest less. I mean, this is a business audience, you know way more about this than I do. Households spend less and overall activity weakens. And the other bars on this chart are similar studies from other countries, so you can see that what we're seeing here is consistent with what happens in other countries. So when uncertainty rises, firms tend to hit pause on hiring and they tend to delay big capital decisions. You know, why invest in new machinery if you're unsure about future demand? You know, why take on debt when you're unsure how interest rates or prices might move given increased macroeconomic volatility? And it's a similar story with households. Uncertainty encourages households to save where possible, and not all New Zealand households have the luxury of being in that situation. But uncertainty, on average, encourages saving over spending. Families, people put off big purchases. People think twice about switching jobs or moving cities. And this is happening in our economy right now. There's a whole lot of wait and see going on out there currently. So these reactions to uncertainty, they're entirely logical at the individual level. It's what any of us would do and probably are doing. But they do risk become self-reinforcing with negative effects on aggregate demand in the economy. In fact, you know, sometimes the uncertainty itself causes more damage than the actual thing that we're uncertain about in the first place. So tariffs may well have triggered the current wave of global concern, but the global drag on growth is being amplified by uncertainty, and it's weighing on activity here at home. All right, so now we're going to pull it all together. You know, the key question for me as a monetary policy maker, you know, what does all this mean for medium-term inflation pressures here in New Zealand, and therefore what does it mean for the official cash rate? So let's start globally. We did a heap of work assessing the likely impacts of tariffs on the global economy, on growth and on trade flows. We used a model called the G-cubed model, which is excellent for this type of analysis, and a heap of sort of expert judgment in there as well. Models only get you so far. The results, as you can see, this is GDP growth, actual and expected, across a bunch of our trading partners, and slower growth ahead for the world's two biggest economies, China and the US, comes out of that analysis and is very consistent with a lot of other commentators around the world. And that matters for us because China and the US, they're also our two largest export markets. Now, in the case of China, it's mainly a demand story. There will be less of it from the US. And in the US, as I mentioned earlier, higher cost, disrupted supply chains are also part of the mix. Oops, what am I doing? Oh, sorry, getting ahead of myself. Okay, so that was sort of growth across individual countries. Here we've aggregated it up to growth in New Zealand's trading partners over the next few years. That's the pink line there. So because, you know, slower global growth, it means weaker global trade. And that compounds the direct effect of tariffs and uncertainty. So for New Zealand, that means weaker demand for our exports, and it means weaker import prices. I just thought it was important to give a scalar on this, so we've compared it to what happened to trading partner growth over the global financial crisis. And clearly that's the blue line there, you know, it's not as severe. So this isn't a GFC scale shock. And that was another global shock with its epicenter in the US. But it is a material slowdown in trading partner growth. Now, I just wanted to sort of note on the way through that the New Zealand dollar hasn't fallen much. There's been a few short-lived dips, but it's actually been heading higher over most of this year, even though we're facing at least into the prospect of a slower global economy. And that partly reflects strong global prices for some of our key exports like beef and dairy. And it also may well reflect questions around the safe haven status of US assets. All right, so that's the global sort of outlook as a result of tariffs and uncertainty. We're bringing it home to New Zealand now. How does all this global turbulence flow through here to domestic inflation? So we ran that global scenario through our NZ sim, that's our own model, to get a sense of the impacts here. We also applied judgment on how uncertainty is likely to affect business investment and households, and we sort of pulled back our forecast for both of those. The net effect is that we expect the economy to grow more slowly through the middle of this year than we previously thought. This is all, as I've said at the beginning, based on the May monetary policy statement. Of course, this isn't the only thing going on at the moment. It comes against a backdrop of strong export prices, inflation expectations that had picked up a little bit. And we were a little bit unsure about why inflation expectations in New Zealand picked up, possibly reflecting the sort of narrative out of the US, where tariffs are expected to push inflation higher. But for New Zealand, when you pull all the pieces together, we see that tariffs and uncertainty are leaning against inflation pressures in our country. That's why in the May monetary policy statement, we nudged our projected OCR path slightly lower. That's the pink line on this graph compared to February. It wasn't a dramatic shift, but enough to reflect the growing weight of these forces. Now, of course, the story I've told you is just a forecast. It comes with a strong dose of humility. It probably won't come true. Especially now, there are big uncertainties around how all of this will play out. We don't know how foreign governments are going to respond to increased uncertainty and tariffs. We don't know how consumers globally are going to respond. Our models sort of guide us, but that's all. But fortunately, monetary policy is not set and forget. We reassess 7 times a year. We use the latest data, the latest research and modelling, our own and that of others. And we also test our thinking. We run alternative scenarios. We're always asking ourselves, what if? Or doing what if exercises to help us understand the risks that we're facing into and sharpen our decisions. In the May monetary policy statement, we published 2 such scenarios alongside our central track. You can see them in this graph of the official cash rate. In the first, we asked, what happens if global demand weakens further and trade diversion is larger than expected, and this would pull inflation down in New Zealand, and it would likely call for a lower official cash rate. In the second scenario, global supply chain disruptions assumed to cause a bigger cost push shock to the global economy. So our domestic economy would still slow, but inflation pressures would rise given sort of a less efficient supply side to the global economy. So in that case, the Monetary Policy Committee, we'd face a tougher trade-off between keeping inflation sort of in check and avoiding unnecessary economic pain. Of course, in the interest of transparency, we published our projected OCR paths for both scenarios. Not to say this is probably what's going to happen, but just to highlight how wide the range of outcomes could be in a world of rising tariffs and high uncertainty. Thank you so much for sitting through all of that. I'm going to bring it home just with a few conclusions. So to conclude, we see tariffs and rising global uncertainty as a negative global demand shock. Yes, it's true that tariffs are disrupting supply chains and may lift costs in some parts of the world, particularly the US. But for us here, the biggest story is about weaker global growth and softer export demand. And uncertainty, it's weighing on investment and household spending, so that means a slower growing economy over the middle part of this year. The economy is still in recovery mode, but the recovery is being held back by uncertainty, and you put all that together, it also means slightly less inflation pressures over the medium term compared to what we were thinking previously. But I just want to be clear as I end, this is not business as usual. The global environment is changing in deep structural ways. Long-standing trading relationships are being redrawn and global political risks are elevated. And these aren't temporary disruptions. They're signals of a more fragmented, more volatile world economy. And that matters a great deal for us here in Aotearoa, New Zealand. As always, we will use monetary policy to keep inflation low and stable and to support economic stability. But I just want to end by saying, there's a broader challenge here, and that is to improve the supply side of the New Zealand economy so that we can stay flexible, responsive and resilient as the world changes around us. So this means investing in skills, adopting technology, and locking in future growth in our economy. So it's about improving productivity and it's about improving the quality of the public debate around these issues and making decisions that help us to adjust and grow. And with that, I'm going to leave it there. Thank you for your patience as I kind of worked through all that. Very much appreciated and very open to Q&A. Thank you.
Cool, thanks, Paul. I think we've got a couple minutes for questions. I've got this little bar here, so if you can just wait for the mic. Maybe I'll start us off, Paul. So the government has a double export value goal that they want to achieve within 10 years. It's a pretty gloomy outlook, which you've just given us. How do you see that forecast affecting the ambition?
I get in trouble if I comment too much on current government policy. I will say it's an ambitious target to double exports. I think it's challenging. As I said in the speech, the export share of GDP has actually been going backwards for a number of decades. I think that really costs us. The fact that we're so small and not particularly well connected globally is one of the main reasons why productivity in New Zealand has not been that impressive. So, full power to the government and to the businesses in behind that, actually. I think it's sort of up to businesses. The government creates the incentives and it's businesses that need to do that. I think in terms of the agricultural sector, that'll get us, so far. I think it's there's environmental limits there. But I think it's about increasing the value of what we do produce in that part of the economy, and there's encouraging signs that that is actually happening. And then it's about different markets. I'll note that sort of trade and services outside of tourism is kind of the bright spot for exports in New Zealand. That's the bit of the export basket that has been increasing, and it kind of makes sense because given our remoteness, trading products down fibre optic cables. It's weightless. It's good, and we're sort of seeing that in the data.
Paul, a question about interactions. There are two aspects of the global economy you didn't mention, but I'm interested in your thoughts about how they're going to interact with the tariffs and uncertainty. And the first is fiscal situation in many global economies. The United States, the obvious one.
Yeah.
And the second is asset markets. Would you like to comment on the potential interactions?
Yeah, I sort of hinted at that. I had a sentence in there, Simon, about the sort of safe haven status of the US. I think that fiscal policy in a number of countries, not just in the US, is really starting to be a headache for monetary policymakers in some parts of the world. And I do think that some fundamental questions are being asked about the risk-free status of US Treasuries. It's not I think it's sort of the action that we're seeing has been in terms of hedging. I think the question is being asked. I don't think flows are being that dramatically affected at the moment. But yes, I think that is very much something to keep an eye on. I think it's a challenge for us all, and it is. As well as tariffs, I sort of talked about geoeconomics. I talked about economic tools being used for strategic purposes as well as sort of economic purposes, and I think that is potentially problematic for the global economy going forward. It's part of this, sort of volatile mix that we're living through currently.
Paul, Roger Beaumont from the Banking Association. Once the US tariff situation is finalised and the current uncertainty becomes, if you like, a bit more stable, how long do you think it'll take for the new normal to be in place?
Yeah, it's an interesting question. Like the literature on the uncertainty point is, the higher it stays up, the sort of longer the drag on economic growth. Like a short spike in uncertainty isn't that big a deal, even if it goes extremely high. But if it goes up and sort of stays there, that can sort of suck down growth. I'm not sure that we're looking into that. I do think there will be a sigh of relief when we sort of, the tariff kind of schedule of the US does sort of remain constant. It's not just the fact of tariffs, but the fact of them changing all the time, which is contributing to uncertainty. And I do think there will come a point where we just have to get on with it, even though global uncertainty, even if it remains elevated. And in terms of our projections, I talked about the economic recovery sort of running into a bit of a roadblock over the middle of this year. We've still got positive growth in there, but it's a bit lower than it was in our projections at the end of last year. But we do have growth returning to New Zealand. We do have that recovery getting a bit more firmly established and picking up towards the end of 2025. So yeah, to answer your question, Roger, we will get through this. We will get there.
Hi Paul, a question online from your 160 fan club members. At the time of the May meeting, the Reserve Bank had Q2 growth at 2%, now it's showing 1%. So how surprised are you with this quick shift, and what are the chances of fresh recession in New Zealand?
I kind of, that sounds like a bank has asked that question. And I kind of said I don't want to comment too much on current economic developments, because I'm here to sort of tell the story of the Monetary Policy Committee, and we haven't sat down to think about all of that. But obviously there's sort of high frequency indicators that suggest that growth in the second quarter was a bit weak. We did actually have that in our projections in the May monetary policy statement. So, and we did a lot of work on this for that statement. So we're not particularly surprised that the economy has slowed, or appears to have slowed down over the middle of this year. Of course, we'll get GDP data at some point that will confirm or otherwise what those indicators are telling us. In terms of the outlook for the official cash rate, in our monetary policy review, which is only a couple of weeks old, the committee did sort of reaffirm and say that the rates track that we had in May, which was the pink line on the graph before this one, was still pretty much what we're looking at that time in terms of the future path for the OCR. Of course, we get to do it all again. We're going into forecast week in a couple of weeks' time, and we'll be out with the August MPS, which will no doubt be different in some ways from the May MPS. It's a moving feast for macroeconomists currently.
Kia ora, Paul. Dan Brunswick from Interest back here.
Oh, hey, Dan.
Hey, you just talked about those three scenarios, and one of them obviously was net supply shock, net demand shock, and yet you're saying that the committee's view is still that we're on the pink line. What do you expect us to be on the negative demand shock line? It kind of sounds what your speech is saying today, that we're in the negative demand shock scenario, not the central scenario.
The central scenario incorporates a significant weakening in the global economy. So there is a negative global demand shock baked into that central scenario. That alternative scenario was, well, what if this is a bit more extreme than what we were thinking? So we've still got it in there. In fact, essentially this presentation, it's kind of going behind that May MPS and looking at a lot of the analysis that we talk about around the monetary policy table. Because, in the actual document, I think we might have had 3 or 4 pages on the effects of tariffs and the effects of uncertainty. And just given how important those issues are and given all the work that we'd done on it, we thought making a speech on it would be useful to sort of spin it to a broader audience than who reads the MPS. But what I've said today is very much consistent with that central scenario that was in the MPS. There's no sort of new update involved in it. It's consistent with that OCR going a little bit further south from where it is currently. I think it troughed, it was at 2.85 or something like that.